Hey, what's up, everybody? Welcome back to Investing Sucks. And today I want to do a video on a concept that I'm sure a lot of investors these days are appreciating and they're starting to think more about. And that is the concept of downside risk or managing downside risk and basically ensuring that your stocks don't get crushed after you buy them. And I consider this somewhat of a timely video given what has transpired over the past year with some of the more speculative stocks. And one of the most extreme examples of this is something that's occurred over the past 2 weeks with a company called Voyager Digital. So this is actually a TSX listed company. And this is a company that became pretty popular over the past year because some of the more popular and notable finance YouTubers were very optimistic about this company. And as you can see on screen here, their price went up very drastically in a small period of time and has since come down. Now, I know a lot of you guys that watch me, you guys are smart, seasoned investors, and you probably know that if a bunch of popular YouTubers are talking about a stock and how it's going to 10x, and you tend to sense some real fanaticism behind a specific stock, it's probably best to steer clear of it. And even if it does go up in the short term, really anything can go up in the short term. That doesn't necessarily mean it's going to be a good investment. But this got me thinking a lot about downside risk and what we can do as retail investors to mitigate our downside risk. Now, obviously, there's risk with any sort of investment. If you want risk-free investments, then go buy government bonds. And even though I personally would argue that even those aren't risk-free because there's always the risk that inflation could outpace the bond yield, causing you to lose purchasing power if you do buy government bonds, but really that's a separate topic. Every investment does have risks. Some have more risks than others. And it's vitally important as a retail investor to fully understand what could go wrong with a company you're investing in rather than just focus on upside and what could go right, because there's a lot that could go wrong with pretty much any company out there. So, what I decided to do was run a little bit of an experiment to see what sort of sources we can look at to get a better understanding of downside risk. So, that's what I'll show you next. So, when attempting to understand downside risk, the natural place I think to start would be the risk section of a company's annual report. Now, I was curious to know how comprehensive the risk section actually is, meaning, does simply reading the risk section tell you all you need to know about how a company could lose money and potentially get crushed, or do you typically need to take it one step further? So, I decided to do a little test where I looked at a few companies, the four companies that I have in the Excel file I'm showing you here, that some of them have recently gotten pretty decimated in the stock market, some more than others. But one, the Blackberry one, was one that was kind of more long term. And I was curious to see, did the potential downside risk, what we now know caused the company to lose so much value, was that specifically called out in the company's risk section? Because if it is, then maybe we can start to conclude that reading the risk section would give us a good understanding, or if it wasn't, then maybe reading the risk section is a waste of time, or maybe it's somewhere in the middle. So some of these companies are more notable than others. I wanted to have a little bit of a mix, and I included the decline from their all-time high just to give an understanding of how drastic their price decline was. So I'll go into a few of these examples now and kind of explain what I mean. So the first one is Netflix. So this is obviously a super popular company. Most people know about it. Declined from the all-time high, about 70 to 75% decline. And really the reason was because their subscriber growth did not meet expectations. It was kind of a shift in the company from being a growth story to maybe thinking that, okay, it's reached its peak and the competitive pressures are starting to take over, and maybe they're not as dominant of company as we once thought they were. So was this called out in the risk section? It was. They did mention just general competitive pressures, but really all companies will have that, right? Because every company is in a intensely competitive industry, right? You're not going to really see a company in their annual report say, our industry is not very competitive and we're a dominant company, because that would probably open them up to some sort of regulation or antitrust suits, things like that. Companies generally want the public and regulators to believe that their industry is competitive and they're just a small part of an ecosystem and they're struggling to survive. But with Netflix, we kind of saw this take place. This is an actual snapshot from the risk section. It's kind of long, so you can really just read the subtitles here. Like this one here says, "And our efforts to attract and retain members are not successful, our business will be adversely affected." So I would say if you were to read that, then you would probably understand that, yes, what ended up happening with Netflix was a real risk, even though still like having the foresight to actually foresee it take place is another story. So I would say for Netflix, yeah, you probably would have got a good idea reading the risk section. But let's look at Voyager Digital. This is kind of a different story. So they've declined almost 98% from their all-time high. And the reason, some of you probably already know this, but basically they have a very significant amount of counterparty risk because part of their operations was loaning crypto assets to other hedge funds, and they didn't really specify who all the people they were loaning it to were. They, in their annual report, they just kind of referred to them as counterparty A, counterparty B. But basically, if the crypto markets were to fall, then for one, Voyager Digital stock would probably go down a lot. And the companies that they're lending their crypto to would probably face difficulty in repaying those crypto. So this wasn't really explicitly called out in their annual report, as we'll go here. They didn't even really have a risk section. And the company that is, I believe they're going to default now, I think that's been announced, is Three Arrows Capital. I didn't even see a mention of Three Arrows Capital in their MD&A or their financial statements. This is kind of what they have as their risk section here. They are a TSX listed company, so they don't have a 10K where they have risks explicitly stated. But you can see it's very general stuff, right? Decline in the cryptocurrency markets or general economic conditions, right? This doesn't really tell you a whole lot. So personally, I think if you were to read this company's annual report, you would kind of have to infer it's not going to be explicitly stated to you that this risk is real and it's something that could lead the stock to just get absolutely decimated. And of course, things still aren't over for the company, right? It's still around. Maybe they can recover. We'll see how it plays out. And then this is what they mentioned about their loaning operations. So crypto assets loaned, as we can see here, they're detailing what the actual coins are they're loaning. So you can see Ethereum, Bitcoin, and then these are who they're loaning it to and at the rate. So they don't even say who they are. You can see it's just counterparty A, counterparty B. So to me, it's a pretty glaring risk because for one, if we look at what actually ended up happening, there's going to be a default on a loan of about $667 million, and their current market cap is about 110 million. So that one loss on that loan, if it doesn't get paid back, is almost 6 times as big as the company's current market cap. So that's a huge loss, right? That's really something that can hurt a company. And the one thing that I think would be good to have the foresight to see in this specific scenario is you say, okay, let's imagine a future scenario where crypto markets get hurt. Obviously, the companies that Voyager Digital is lending their crypto to are going to face trouble, right? And in that same scenario, when crypto markets start to crash, Voyager Digital stock is probably going to go down. So if your reasoning of maybe seeing this counterparty risk and thinking, maybe it's not a huge deal, was that they can always just raise more stock. I mean, their shares are $25 a share, which I think they were at one point. Now it's, 50, 60 cents. You could say they could just issue more stock and they could cover that loss. But in a future scenario where crypto crashes and those events actually play out, Voyager Digital stock probably also crashes along with it, and they can't raise capital in order to do that. Now, obviously, me saying that, it's pretty easy for me to say that because hindsight is 2020. We know everything that's taken place, but being able to actually foresee that is much more difficult, and it requires more knowledge, more experience. But I do think it was definitely something that if you were going to invest in Voyager Digital, you should have seen coming. So that's kind of my conclusion there. So if we move on to Target, so this one not as extreme, but it has declined quite a lot, and pretty recently. It's declined about 42%. And really the reason was because of inflation. So there's less discretionary spending, and Target sells a lot of discretionary items. So they had to mark down those items, so reduce the prices just to sell the inventory because their inventory was starting to build up. Consumers were becoming a bit more tight about how they were spending their money because a lot of their money was going to more vital things like food and gas. So they can't spend on discretionary items. So as a result, they had to mark down the prices just to sell that unwanted inventory. So was this called out in their risk section? My conclusion is it sort of was. If we go to their risk section, they have this section here which says our earnings depend on the state of macroeconomic conditions and consumer confidence in the US. So from that, I think that's pretty obvious, right? With Target, obviously their business and their success is going to be tied to the general health of the economy. But can you really infer what actually ended up happening? I do think it's possible, but it would have required some really, really strong foresight into seeing how events would have played out in the future. Like you would have had to say, okay, one, inflation is going to be higher than expected. Two, inflation is going to be targeted towards essential items like energy and food. And three, that's going to lead to people reducing their discretionary spending, which will then lead to a buildup in Target's inventory. They then have to mark down that inventory to sell it, which will lead to depressed margins and lower value of the business. To me, making all those connections is pretty difficult, not impossible, but pretty difficult. So yeah, that's my conclusion there. Now, the last one is Blackberry. So this one is one that's kind of taken place over really like a full decade now, or even 2 decades. So it's declined almost 97% from its all-time high. And BlackBerry was once a very strong company. They were the leaders in the phone market, but what happened was competition from Apple's iPhone that made them essentially obsolete. The iPhone had a superior operating system, the design was a lot better, and more people wanted it than BlackBerry. And this was kind of a similar thing to Target. Was it called out in the risk section? It sort of was, right? They called out competitive risks and say if they can't innovate and continue to stay market leaders, then their business will be adversely affected. So we can take a look at what was actually here. So this is from their 2008 annual report. And the reason I chose 2008 was because BlackBerry introduced their smartphone in 2003. Apple launched the iPhone in 2007. And then kind of in 2008, 2009, Apple and BlackBerry's market share were roughly equivalent, but Apple was gaining fast. So in the 2008 annual report, you would have expected if they called out this risk specifically to say, Apple is catching up with us. They're gaining tons of market share. There's a real risk here that their products are just going to be better than ours and we're going to become obsolete. Now, obviously, they're not going to say that in their annual report because if they did that, people would probably sell their stock in, huge quantities and it would crash. So they're only going to do basically the bare minimum of what they're legally required to do, which is just to say in their risk section, just general competitive risks, right? I'll read it here. The company may not be able to enhance its current products or develop new products in a timely manner or at competitive prices. So that gives you a general idea, right? But that's kind of obvious in my opinion. And again, it would require really strong foresight to be able to predict what actually ended up happening. You would have probably had to have some specific industry knowledge to say that Apple's iPhone is just a superior product. BlackBerry is going to fall behind, and as a result, BlackBerry is going to get crushed. So you can see kind of a common theme with a few of these companies, right? Like Netflix, I would say if you read the risk section, you would have gotten a pretty good idea of what could have led to that company getting crushed. Voyager Digital, it's kind of same thing. If you not really read the risk section, but kind of just read their filings, you should have noted that there was a huge risk there with their lending operations. And if crypto markets were to crash, which is something you should have priced in if you're looking at the company as a potential scenario, then they could have one loss on one of their loans, which would vastly exceed the company's own market cap, right? That was a possibility. And then with Target and BlackBerry, I think if you read the risk section, I mean, it wouldn't really have done much for you. It would have said, here's a few things you can look at. But in order to actually predict what happened, you needed very, very strong foresight and probably even specific insider industry knowledge into these specific industries. Now, another point I'd like to make, going back to Voyager Digital for a second here, is sometimes the biggest risk that is facing in an investment is just the fact that the company is simply overpriced. It may be vastly overpriced, right? And this is a huge topic on this channel. I talk about it all the time. You have to understand price versus value and what kind of future performance is being priced into a stock at whatever valuation it's selling at. And that's not something you're ever going to see called out in the risk section, right? A company's not just going to say, as part of the risk section, our stock is overpriced, and if we can't deliver on these lofty future performance expectations, then the stock's going to get crushed. So that's something that you kind of have to infer as well as an investor. Now, something else I wanted to do was actually show a real-time example of a company that I'm specifically looking at and trying to understand the downside risk of, because it's a company I'm interested in potentially opening a position in, and that is Micron. So they recently released their quarterly earnings, and it wasn't really a huge surprise. I think a lot of people predicted that it probably wouldn't be a great earnings release, which it wasn't, and the stock to go down a little bit. But if I go to the SEC filings as well and take a look at their most recent 10K to try and understand this a bit better, because they're going to have their risk section here. And the whole goal of what I'm trying to do with Micron now is understand the downside risk, right? Understand the future scenarios where I could lose money if I buy into them at their current price. So they list them here. And again, these are all pretty generic, right? We may be unable to maintain or improve gross margins, right? Every company, that's a risk for. One that's specific to Micron is they're talking about average selling prices of the products they sell, because it is kind of a commoditized market. I did a whole video on Micron about a month ago, so I'd advise you guys to check that out. I go in depth on the business. But one really prevalent risk has to do with China. And there is, maybe due to whatever happens with the US-China trade war, maybe there's a possibility that China may just shut out Micron from their operations. And that would be that's a permanent loss of business that is going to be hard to recover from. And personally, I don't know how likely that is, right? I'm not familiar with the nuances of the US-China trade war. I can't foresee the future, but it's something I kind of have to take into account as a possibility and figure out a way to manage. Because Micron overall, it seems like a solid business, one that is cyclical, but generally goes up over time. But there are certain risk factors that personally I can't really make sense of. And if I can't really make sense of it, then it's probably going to be something that I avoid, because I'd want to make sure I actually understood that fully before investing in them. But anyways, guys, that pretty much does it for me for this video. So thank you so much for sticking around and listening. I hope you did find this insightful and useful. And if you did, then please leave a like. And if you're new to my channel, I'd appreciate if you'd consider subscribing. And I'll see you guys in the next video.